Well, good morning, Jagender Rana here. Topic for our discussion today is creditor insurance. Creditor insurance. In today's credit happy society, an insurance cover which mitigates the risk of repaying credit if death or disability happens to the debtor is very relevant. So, let's understand how creditor insurance, by looking at the features of the product, benefits and problems faced, and the relevance of creditor insurance for the Indian insurance market. This is an insurance cover designed to mitigate the risk for the creditor of the debtor's death. So, disability or unemployment, creditor insurance rests on the premise that legally, creditor has an insurable interest on a debtor's life. So, when the creditor gives a loan, he also gets a life of the debtor insured for the amount of the loan for a period equal to the tenure of the loan. If the debtor dies, becomes disabled or unemployed, the benefit is paid to the creditor who adjusts it against the outstanding loan. So, creditor insurance can be of three kinds depending on the type of credit. Decreasing term coverage for closed and installment loan. This is a normal mortgage, consumer, educational or automobile loan where the loan balance decreases with the repayment of regular intervals. Now, ordinary term coverage for single payment loans. Here the loan repayment is in a single lump sum and the outstanding amount will not decrease. Varying amount insurance coverage for open end or revolving credit. So this is for credit where the outstanding amount varies from month to month. For example, credit card balance. Generally, the mortgage and loan-based creditor insurance has more penetration than insurance for revolving the open-ended credit. The risk covered under creditor's insurance are death, disability and uncertainty. We can say unemployment. These coverages are always within an upper limit that an insurer is willing to cover on a life. So it can happen that some larger loans can go partially uncovered by insurance. So if you go for type of risk, say for example death. So what kind of claim would be there? Settlement of claim amount is paid to the creditor on the debtor's death to adjust against the outstanding amount of loan. Now, in case of disability, claim is payable on occurrence of disability as per the definition under the policy. So, there is normally a waiting period before the claim is payable. After this, some policies pay disability benefit with retroactive effect. That is from the first day of the actual disability, and others pay after the waiting period. So, which is known as the elimination of period. So, the usual restriction for disability claim exists in these products. And then comes unemployment. So, benefit is payable if an insured debtor loses his job due to layoff and termination, and maybe due to labor disputes and strikes. So most of the plans would not cover a job loss due to registration, retirement or illness. There is an issue in voluntary unemployment when someone is forced to leave due to the employer's tactics. Now, Originally developed in USA, Creditor Insurance has experienced spectacular growth throughout the world. A major reason for growth is the credit culture in Western economics and this product being seen as a protection for both the lender and the consumer, that is creditor and debtor, against unforeseen events like death, disability, illness, and unemployment of the consumer, restricting the ability to repay the debt. So this product is also popularly known as payment protection insurance in some markets. The growth of this product line is in the US market has been spectacular in the initial years, but it has also been dogged by controversies of customers being taken for a ride by the insurance companies and the lenders. Problems faced in the Western market were this product is seen to be overpriced. The rates charged all over US are very excessive. Excessive commission to lenders on insurance selling and unethical selling practices. Lenders making more profit out of the insurance selling than the credit transactions. Commissions are high while claim payments are low. High profits for both the insurer and the lender, and the customer benefits are not commensurate. So there is a lot of ambiguity about the products, the covers available, exclusions, etc. In most agreement, the insurance company shares the distribution commission, a fee for sharing the administrative burden, and the profit from the scheme with the lender partner. So in addition, the lender also benefits from the claims without paying the premium. Now, due to this, there is considerable suspicion in the minds of the debtors that the product is not beneficial for them and they are being fleeced to line the pockets of the insurer and the lender. So additionally, there is considerable ignorance about the product and the need for underwriting the risk. In fact, the level of compliance on this product line is so much that it has become a bane for regulations and consumer bodies. But this can be learning for the Indian companies and the regulators while this product is being introduced. So today, Creditors Insurance in US is facing a situation of low growth due to the problems, comparable debt protection products from banks and stiff regulations in a lot of states. Now the question is position of Creditors Insurance in the Indian market. Elsewhere in the world, except the US, Creditor Insurance is thriving. So premiums are growing at rates of 30-40%. Consumers' credit is growing in other societies around the world. And credit insurance is necessary and affordable. But the same is true of the Indian market because the various insurance companies in India have introduced creditor insurance for different kinds of credit. Individual and group creditors, life policies are available in the market. So even though death and disability covers are being provided, unemployment cover is not yet prevalent in India. If you see, insurer is Life Insurance Corporation of India. Product detail is group creditor insurance policy to cover various loans like housing loan, vehicle loans and others. Individual policies to cover housing loans. These are not pure creditor insurance as they also have a saving component. SBI Life is giving a product named Protection Plus, which is a group credit insurance plan, which is available to SBI credit and card holders. So this has an additional cover for death or disability due to accidents. HDFC Standard Life is giving a loan cover term assurance, that is an individual creditor insurance plan. So the death benefit is designed as a decreasing benefit, coinciding with the decrease in outstanding loan balance. Home Kotak Mahindra Life is giving a credit term group plan which provides life cover for a group of borrowers with the same credit institutions. This plan comes with an accidental disability benefit which covers the risk of total and permanent disablement as a result of the accidents. Now, target markets for the Indian insurance companies is that this might be an interesting product for the new insurance companies as the number of lives covered can be increased considerably, and this does not require extensive administrative infrastructure. So Indian market with its burgeoning middle class and increasing consumer credit culture is definitely ready for this product line. So the target market segment would be the employed middle class, the rural middle class, the small traders and the independent business owners, lower or middle income customers, loanee of micro lending agencies. So the steps to grow the market share of creditor insurance is required because companies have to design good products and price them reasonably, generate trust in the mind of the consumers about this line of business, increase the general awareness about the product and the advantages to the loanees and creditor institutions, then generate awareness among lending institutions to sell creditor insurance with loans. So the creditor insurance product is interesting for the insurers, lenders and the loanees. The product is useful and relevant if priced and positioned well. In the Indian context, unemployment insurance may be difficult to manage for some more time to come. The regulator has a role to play in seeing that the product is designed, keeping the customer's interest in mind. So the customer's interest have to be taken care of and should not be sacrificed at the altar of the insurers and lender profits. Customer awareness has to be increased so that the customer does not blindly buy the product. The buying decision should be made after they fully understand the implications of the benefits and exclusions. In a society of low earners, this product, if priced appropriately, has considerable social relevance since the death or disablement of the breadwinner takes many an Indian family into penury and eternal indebtedness. So this is a product which has been introduced by many companies now because the three basic components of death and permanent total disability as well as employments are covered under this policy. Most of the companies have come out with this product, and this is, as on date, a popular cover because creditors insurance is common nowadays, and the financiers also want full protection of their loan amount. Thank you very much.